Let's have a look at central banks loaning or leasing gold. The concept of leasing a physical object like a home, a car or a piece of equipment would be to use what is leased, pay for its use and return it at the end of the lease. Now take this concept and apply it to a bar of gold. When you use gold, you either admire it, manufacture it or sell it. But since bullion banks don't lease large quantities of gold to exclusively admire it in their own access restricted vaults, and they don't manufacture golden products, the question is, do their gold transactions with central banks actually constitute a lease? Well, let's see. If the metal belongs to someone else and you borrowed it and sold it to another party and pocketed the proceeds, I would tend to view this as a sale. A fraudulent sale, that is. Selling what you have borrowed and promised in return is a short sale. Eventually you have to buy back what you had borrowed. So the leasing of gold is just disguised short selling. Or, as we find out later, in practice it might not even be short selling, but just straight selling, as central banks can't demand their gold back without driving its price through the roof. Let's have a look at the classic gold leasing scheme, the gold carry trade. Central banks argue that gold in their safes is a dead asset and does not earn them any interest. Storing the gold only costs central banks money for storage and insurance. So they say, why not lease the gold to others? So in this scheme, gold is being leased from central banks to bullion banks at an interest of 1% a year. And bullion banks don't keep the leased gold but sell it to the market for cash. And the cash is used to buy bonds or treasury bills that, let's say, earn them about 6% interest a year. So the bullion banks is net short gold but makes in the end of the circle 5% interest a year. As long as the price of gold stays the same, the bullion bank can buy back the gold the central banks lease them and will continue to make a nice profit of 5% a year. When large enough quantities of gold are leased to the market will be overwhelmed with supply and the price of gold will fall. In this scenario, which occurred in the second half of the 90s, bullion banks also make a profit from buying back the gold leased from the central banks at a price lower than it was sold for in the first place. This gold carry trade faces difficult times, however, when in this example the price of gold rises over 5% a year. As long as the interest that can be made in this carry trade is positive, participating on the leasing scheme remains lucrative. However, the price of gold over the last decade has gone up on an average over 15% a year. So why would this carry trade on a large scale still continue to the present day? One explanation could be that the leverage on the carry trade is still above 15% a year. This, however, is very doubtful when looking at returns of bonds or the chart of the Dow measured in gold. Another possibility is that bullion banks buy gold futures contract to hedge their risk of a rise in the price of gold. In order to do so, they have to go long on the futures market. This way they can profit from the sale of their futures contracts when the price of gold rises, and a modest overall profit from the gold carry trade still remains. However, as we will see, the major bullion banks leasing gold to the market have unbelievable large short positions in the futures market instead of long positions. What would be the wise position to take in a gold bull market? So this scenario of going long in the futures market does not explain reality too. The last explanation could be that central banks do not demand their leased gold back, or central banks cover the short sell losses of the bullion banks. This scenario creates a fantastic money machine for bullion banks. They can short gold with a government guarantee against losses, and can go short gold on the futures market and cover at lower prices. So bullion banks are happy to facilitate in such a gold leasing scheme, and central bankers can suppress the price of gold and can have bullion banks buy their bonds and government treasuries. But you might ask yourself, the leasing of gold without it being returned can't go unnoticed, right? Well, as crazy as it is, it actually can. Central banks are allowed to list leased gold, which in fact is an intangible debt on their balance sheet, as a tangible asset. On their balance sheet, according to the IMF, they don't have to distinguish between deposited gold and gold receivables. As a result, gold and gold receivables are listed as a one-line item on central banks' balance sheets. On this slide, you see an example of the balance sheet from 2008 from the Nederlandse Bank, which is the Dutch central bank. Goud en goudvorderingen translates to gold and gold receivables. As you can see, they are listed at the same post. So leased gold, or gold that has been sold short to the market and is not in possession of central bank, on the balance sheet is being viewed as the same thing as the gold that is in the central bank's vault. It seems Orwellian doublethink to me to treat the intangible debt the bullion banks have to return the gold like a tangible asset on the central bank's balance sheet. But the nation-state independent supranational IMF does approve this accounting method, so I guess we shouldn't have to bother to take a critical look at this accounting principle for ourselves.